Hello and welcome to video 3 of our retirement series, where today we're going to be tackling the question, how much money do I need to retire?
Ain't a cloud in the sky, ain't a worry in my mind. Looks like we're in the clear.
We're going to be looking at 4 key things that you need to consider when you're tackling this question. Number 1, we're going to be looking at when you're going to retire. Number 2, how much money, and look at how to calculate some rules of thumb and some guidelines to help you answer that question. Then we're going to look at the sources of money. We're going to determine, how much I need, where's that money going to come from. If we identify a gap, we're going to look at ways that we can, steps we can take to fill that gap. We're going to start with what I think is the easiest of these questions, is when you're going to retire. Some of you may already have an idea. If you're in your 50s, you probably have a destination in mind. Even if you're in your 40s, you may have. It's tougher to answer this question if you're younger. I mean, if you're in your 20s or 30s, you may have a vague idea like I'm going to retire early, or have some rough number. But because it's typically decades away, it's not realistic to have it nailed down to a particular day. But the things we're going to learn and discuss today will help you when you do get to that point. Few things to consider when you're making that decision of when I'm going to retire. And the first thing is your health or your life expectancy. I mean, in a nutshell, if you have poor health, sadly, or if you have a shortened life expectancy, then you're going to need to provide for fewer years in retirement. And obviously, how many years in retirement really plays a big role in how much money you're going to need to create, or how much wealth you're going to need to create to get to that point. Secondly, if you have a long life expectancy, if all of your family members have lived to 90, 95, 100, well, then that's going to present a bit of a challenge, because you're going to have to build up a bigger nest egg, I guess, to provide for decades of funding in retirement. Second thing to consider: do you have a partner? Do you have a spouse? Are you married? If there's 2 people involved in this retirement question, it should be discussed, and it kind of makes sense, but it's not always the case. You may have an age gap, and let's say one partner is 10 years older than the other. Are you still planning on retiring at the same time? Those kind of lifestyle questions that you might not think about, because we think of retiring sort of in this aspect as a number crunching exercise, but there's a lot of psychological or lifestyle considerations that have to go into place as well. Another significant consideration to factor in is your career. If you work in a job where you love going to work and it's easy on the body and you have no rush to retire, well, that could push things back a little bit. Conversely, if you work in a job where you just struggle to go to work every day, or maybe it's hard physically, and you feel as you get a little bit older you're not going to be able to do the job properly, well, that might prompt you to move that day a little bit more forward. Another consideration is, flat out, can you afford to retire? It's one thing, let's say you're 50 and you want to retire at 55. Once you crunch the numbers, you just may not be in a position where that's feasible. So that will also factor in, and that's what we're trying to do here, is narrow in on what that date might look like for you. Something interesting that I saw in my career as a financial planner is that a lot of people pick that retirement date, ahead of time. And then as you get closer and closer, people tend to delay it a little bit, push it back. And it wasn't uncommon at all. And just as an example, you might have had someone say at 50 who said they're going to retire at 56. They get to 54, 55, and that decision day comes. And it's quite common that they're going to say, you know what, I'm enjoying my work and making good money right now. So they tend to maybe push it back to 57, and they get to 56, and maybe push it to 58. I saw that quite often. Hopefully you're in a situation where you're enjoying your work. And, if it comes to that, where you don't want to necessarily hang up your shingle yet, that's something that you're in a position to be able to do and enjoy it. Question number 2 that we need to answer, and this is a critical part of this whole equation, is how much money I'm going to be spending when I get to retirement. And that will dictate how much money you need to provide for that income, obviously. 2 ways we can go about this. There's rules of thumb, which I'm going to cover off a few of them here, and that'll give you sort of a ballpark idea. And then there's just sitting down and doing the calculations. It's a more labor intensive, but it does prove to be more accurate. I'm going to cover both of them right now. You can do most of these numbers online today, or you can consult a professional to do that for you. When I was working, I did prepare financial plans, and the biggest benefit I felt to people who got financial plans prepared for them tended to be closer to retirement. So maybe you're 5 years out from retirement, or 10, and you can kind of see that finish line. The number one benefit that people got was if they felt they're in a position to retire, was essentially to confirm that, a sort of validation that, yes, I'm on the right track, and you don't need to change anything or change a few little tweaks here and there, and that will get you to that finish line. There is a very valuable resource, I would say, on the Government of Canada website. I think they call it the Canadian or the Retirement Income Calculator or something to that effect. And I've gone through it myself, and I'll show you a few screenshots here of what that looks like. Essentially, it's a calculator where you can answer some basic questions. So then you start entering information like what year you want to retire, things like your monthly expenses, your income, whether you're going to be, getting maximum CPP, OAS, etc. And then you go through and fill out the different parameters, and it does a really good job of providing you with a graphical view of what your retirement is going to look like. It also might raise a few things that you hadn't considered, such as when you're going to be starting your CPP or your old age security, those types of questions. Near the end, it provides you with a summary and a good estimate of whether you're going to, whether you're on track, whether you have a bit of slush fund. It's something, and beyond that, you're able to go and print out a report. And this might be a really good starting point to just gather the information, and it'll help you sort of home in on what that number is going to look like for you. Regardless of whether you get it done professionally and have a financial plan prepared, or whether you do it yourself online, there's a few things that a few challenges I would say that you're going to need to consider. Number one is inflation. Obviously, if we think back 20 years ago or 30 years ago, things were much less expensive than they are today. That pattern's not going to change. So you have to calculate in today's dollars what you're spending, and then the software that you're using should project out and factor in a reasonable level of inflation. Another challenge we have today is we're living longer, with medical intervention, just the life expectancy of people continues to grow. Just as a few examples, I'll show you a table here that comes off the Stats Canada website. For example, if you're 30 years old today and you're a male, you have 48 years of life expectancy ahead of you. And if you're female, you have 53 years. And you can go through the table and pick out your age and sort of see, what a rough guideline is as to how long you can expect to live. Now, there's no way you're going to be able to nail to the penny exactly how much you're going to spend when you retire, especially if it's a few years out. But let's look at some rules of thumb that are commonly used, I would say, as a starting point. They're not going to give you a super accurate number, but let's look as a starting point. One of the most common, I would say, is the 4% rule. Now, this is quite controversial. It was developed back in 1994 by a financial advisor named William Bengen, and he basically came to the conclusion in his study that if you're assuming a 30-year retirement and you're assuming a balanced investment portfolio, in fact, he used 50% stocks and 50% treasuries, you should be able to spend 4% of your income on an annual basis, inflated or going, indexed for inflation, without running out of money. So again, this assumes a 30-year retirement period. Let's look at a mathematical example. And according to his numbers, if you have $1 million available to you to fund your retirement and you use the 4% rule, well, that means you would be able to fund $40,000 worth of retirement expenses, and that would be indexed to inflation for 30 years. So that's not a bad starting number. A few things to consider. Number one is if you are more conservative than that and you feel, well, gee, I just want to have a bit of more of a buffer, then you can lower that number. You can use, say, 3.5% and spend that amount, which would be $35,000 a year with that same $1 million, rather than the 4%. Now, if you feel that I can far outperform that, and just as an aside, to generate that type of to generate those type of numbers, you would assume a 4% rate of return plus inflation. So, roughly in the 6.5%, 7% range. If you feel you can do better than that, well, then heck, you could use 4.5% if you're more confident in that regard. Something else that you have to take into consideration when you're doing this calculation is if you can do a rough estimate of where we are in the economic cycle. And if we look at the valuations of the major indices around the world, they're quite high right now. If we look at, just using price to earnings of the major indices, there's, a considerable likelihood that the markets will drop in value, before too long. At some point, we know that they will. It's kind of unfortunate, but you don't want to time the withdrawals from your portfolio that coincide exactly when the markets drop, only because then if you still take that 4% constantly out, you're taking the 4% from a smaller number if your investment portfolio drops in value. So that's something you might want to consider as far as timing of your retirement is concerned. Also, right now, really challenging with this portfolio. The 4% is derived from this balanced portfolio, including a substantial amount of fixed income or bonds. And right now, interest rates are so low that portion of the portfolio, you may struggle to keep up with that 4% plus inflation. A sister rule to the 4% rule is the 25 times rule. And what this says is essentially that you calculate how much money you're going to need for living expenses when you retire. Then to fund 25 years of retirement, you simply multiply that number times 25. This also assumes you're getting a 4% rate of return plus inflation on that as well. Let's look at a couple of mathematical examples. So assuming you want $75,000 in retirement income. To do the calculation, you take your $75,000 times 25, and that equals $1,875,000. This formula assumes that you have no other sources of income, and the reality is that most people will have some other income, whether it's CPP or OAS or perhaps some pensions. Let's look at some examples of that. Sticking with the $75,000, if that's what your target is, let's assume that you're going to be getting $1,000 a month from government benefits, a combination of Canada Pension Plan and Old Age Security. So we'll take our $75,000, we'll take $12,000 off of that. That leaves us with $63,000 as a shortfall, or as that gap that we need to fill. $63,000 times 25 equals $1,575,000. Taking that example one step further, let's assume that you have a pension that you're expecting to get $2,000 a month, again, indexed to inflation. So now we take $24,000 from pension, we take $12,000 from government benefits, and that equals $36,000. When we subtract that from the $75,000, we're left with $39,000 that we actually have to fund. So in this case, you take $39,000 times 25, that equals $975,000 that you will have had to have accumulated in order to provide, to make up the difference between the government pension plans, your private pension plans, and the money that you're planning on spending. Another example that I saw that was quite common during my working years was a lower income target. So if we used $50,000 income as your target, if we assumed you have a $1,000 pension, let's be a little bit more conservative, and we assume that you're going to be getting $1,000 a month from your OAS and CPP, well, that's $24,000. If we take the $50,000 target income and we subtract the $24,000 from that, that's going to leave $26,000 that we need to make up. 26,000 times 25 equals $650,000 if you're using this 25 times rule. That seems to me to be a fairly common, fairly realistic evaluation of what you can expect when you get to your retirement years. Let's look now at what I call the best solution for calculating how much you're going to need in retirement. And this is, I'm going to say the B word, this is creating a budget. And this word kind of sends some people, running for the hills. And I think back over my career, and I worked with so many clients who had such diverse views on this. And one of the very first couples I ever took on as clients way back when, I remember vividly in a first meeting, the wife said to me, if you ever use the word budget, or if you ever try and put me on a budget, we're going to find another advisor. And she was so, they had assets, but she never wanted to feel like going out and buying a new pair of shoes or something along those lines was something that she didn't want to have the stress of that, so she never wanted to prepare a budget. Now, on the flip side of that, I worked with a couple who probably 5 to 10 years leading up to retirement created a very detailed spreadsheet, and literally every month it was updated with market values, reduction in debt, all of the details of their particular plan. They had their date nailed right down to the day that they were planning on retiring, and it worked very well for them, but they're very, very detail oriented. So it comes down to the person. If you can keep a budget, I think, or prepare a budget, I guess I would say, I think that's the best solution. It gives you a much clearer vision of what you're going to need to fund your retirement. So that's just my advice: is if you can, if you have it within yourself, prepare a budget. Let's look at some tips on how to go about doing that. A couple of really simple ways, if you haven't been keeping a budget, is just to gather the data. So look at your credit card. If you tend to put things on credit cards, look at your credit card bills for the last probably 3 months. Should be pretty sufficient. I mean, a year is ideal because you're going to have sort of the more annual lump sums in there. But even for 3 months, if you go through, pick out, what you spend on gas, what you spend on groceries, that type of thing, it's going to give you a pretty good picture. By the same token, go look at maybe your bank account. So if you have pre-authorized checks for, your hydro bills or maybe your phone bills, that type of thing coming out of your bank account, use the data that's already there to compile. That'll give you a pretty good idea of what you're spending today. When you compile that data, look at what is fixed and what is discretionary. So what are things that are going to continue after you've retired, and what are things that may stop after you've retired? Things like your transportation budget may go down. Maybe you're not spending money on gas going back and forth to work. Those types of things. Just look and see what you have on there that will change when you retire. Once you've gathered that data, there are a few different sources that you can use to sort of put that into something more formal. Number one, going back to the Government of Canada website, they have actually a very good budget planner on there. I'll put some screenshots up. They have a site that you can go to, and they call it the Budget Planner. And if you go through, it will take you through a very comprehensive platform where you can enter, all the relevant data that you would need to prepare your budget, such as your income. Then it goes down into various savings plans that you have if you're putting money away every month for retirement, education, that type of thing. It then goes into your expenses and has a very comprehensive list of sort of the most common expenses that most people would be facing. Once you've entered that information, it takes you to a very comprehensive summary. And one of the things I like about it is it gives you an idea if you're sort of in the ballpark with fellow Canadians. It'll give you some averages and show if you're above average or below average in that respect. It then gives you what I think is quite an attractive graphical report. And for those of you who are more visual, it just helps sort of solidify step number one of the question is, what do you have today? Because if you know what you have today, it'll help you understand what you're going to need when you get into retirement. Another, just a very simple example of how to keep track of this, I'll put a spreadsheet up that I've used with clients over the years, and it's just a simple Excel spreadsheet that shows along the top your various sources of revenue. Then it shows your expenses down the left, and it just goes month by month, and it can show you, if you have some uneven or lumpy cash flow, where you may want to be prepared and have some money saved up for the months where you have some annual expenses or lump sum expenses that may exceed your current income. Something I saw used with great success with the clients I worked with over the years was if you're a year or two away from retirement, and typically, let's say a year out, maybe simulate retirement. So you've got your calculations as to how much you're going to need to spend, and as much as possible, start doing that a year ahead of time. So if you're earning more than you need, save the excess that you don't need and just see how it goes. And you may find that you're right on, or you might find that you need to adjust things a little bit before you actually get to retirement. But it's a good way of going through that dress rehearsal, I would say. And it, like I say, it has really helped people out. That's been my personal experience. So we've looked at when you're going to retire. We've looked approximately at how much your expenses are going to be in retirement. But we need to acknowledge that there are really three distinct phases in retirement. It's not like you retire on day one and your spending habits continue for decades. The first part of retirement, I'm going to call the early phase, which I categorize up until age 70. And of course, it's a little bit arbitrary, but based on my experience, the first number of years, people tend to spend more, tend to travel more, maybe do some work around the house, take on some new hobbies that might cost some money that you may not have had the time to do before. So allow for a little bit higher expenditures in the first years. I'm going to say up till age 70. The mid phase, let's call it ages 70 to 80. Most people still, if they have a bent for traveling, are still going to want to do that. At this point, there may be grandchildren in the picture, and it's not uncommon for people to spend money or to spend time with their grandchildren, which can mean traveling to see them or paying sometimes for their grandchildren and the families to come out. Very common that parents with some wealth are maybe wanting to share it. So maybe they have adult children who have a home or a mortgage, and they want to share the wealth and maybe help them with paying those types of things down. It's quite different for a lot of people, but it can be a phase where you've gone through the early expensive years and now you settle into sort of more of a routine from your 70s up until your 80s. The late stage, I call it 80 plus, and everybody's a little bit different, of course. This is not one size fits all, but the reality is that most people when they're 80 are more content to stay home. They certainly will be traveling less, and their expenditures tend to be a lot less as well. More eating at home rather than going out to restaurants. An exception to this is it's possible, in fact, it's common, that when you get older, you may have to pay for healthcare. So this depends a lot on your circumstances, your living arrangements. But if you are susceptible to possibly needing to pay for care home, then you need to factor that in. I know that there is insurance that you can buy. I was not in the insurance industry. I couldn't even give you an idea of what the rates are. But if you are concerned that your budget doesn't have a lot of extra room in there, in case you need to pay on a monthly amount to be in a care facility, then maybe consult with an insurance representative to find out how much it would cost you today to cover those potential expenses off as you get older. I'm just telling you these three phases because when you're planning for your retirement expenditures, just recognize that, like I said, it's just not one number for the entire 30 or 40 years. It is going to ebb and flow as you move through your retirement years. Also, a couple of last points on this part of our discussion here today. Retirement isn't just financial, it's very emotional. And to think about, to visualize your retirement can be very valuable because it can be an abrupt change. And I know people who have been forced to retire. So maybe getting into some form of a mindset where you anticipate being in retirement, and that will help you ease into that phase of your life. In all cases, whether you're in an early retirement, mid-retirement, or late retirement, it's always advisable to have some form of an emergency fund or a slush fund to have around. There's different rules of thumb, but let's say 3 months of living expenses, just in case something really negative happens and you're forced to come up with some money in a hurry. You don't need to liquidate some assets in order to raise that money. So that's something to consider as well. Okay, step 1, we looked at when you're planning on retiring. Step 2, we looked at roughly how to estimate what your expenses are going to be in retirement. Now we have to look at what sources of income you're going to have in retirement and see if they cover what your expenses are going to be. Let's start with Government of Canada. I'm just going to kind of go through what the common sources of income are in retirement, and you can just pick and choose which ones apply to you and pop them into your spreadsheet when you're doing your calculations. Let's start with CPP. Most Canadians will get some form of Canada Pension Plan. OAS and GIS, somewhere in the $600 range you can expect for old age security if you lived in Canada most of your life. If you are fortunate enough to have a pension plan, it will be one of two types. It'll be either a defined benefit plan, which means that you have a specific amount that you expect to get when you retire. You have no choice in how the funds are managed. And basically the amount that you're going to get is a formula that is calculated. It's based on, most commonly, based on the number of years that you've worked for your employer and your salary, and it's a percentage of that. And that determines how much you'll actually be able to draw on a monthly basis. Some plans are indexed to inflation, some are not indexed. So when you're doing your math, you'll need to check and see whether yours is or not. The other type of pension plan is called a defined contribution plan. And these are much more common these days than they were back in the old days. Defined contribution plan, the amount that's known is the amount that you're actually contributing to the plan. The amount that you'll get when it comes time to retire will depend on how the funds are managed, the rate of return that you get between now and retirement. Less secure, less definite than the sort of the old-fashioned defined benefit plans. If you do have a defined contribution plan, typically when you retire, you're going to take the lump sum that's accumulated in that plan and you're going to roll it out and put it into either a locked-in RSP, a locked-in RIF, a retirement income fund, or possibly an annuity that you would purchase with a life insurance company, again, at the time of retirement. RDSP, a registered disability pension plan. You may participate in a pooled registered pension plan, which is similar to a defined contribution plan, but the employer contributions are optional in a case like that. You may participate in a voluntary retirement savings plan, which is the Quebec version of the pooled pension plan. You may also have non-registered investments that you have that you've accumulated money that you'll now turn into a revenue stream. Another relatively common strategy when you retire, especially in certain pockets of the country like Vancouver or Toronto, for example, where the price of housing is quite high, you may have a large amount of equity built up in your home. It's very common that you may at some point in retirement, typically not early, but at some point later in your retirement, you may downsize and sell your home buy a less expensive place, whether it's a smaller place or whether it's in a smaller community perhaps, and the money, the difference in the equity, you will use that. That'll add to your income pool as well. Another less common but available source of income, if you do in your home, is a reverse mortgage. So this is essentially where you take your home and you borrow against it. And as long as you're living in the home, you have that debt against the home, but it frees up some capital so that you can use that for living expenses. Last on the sort of most common methods of funding retirement, and although a lot of people don't want to even think about this, is inheritances. And a lot of people will be inheriting money. And I've always thought, as I was preparing financial plans, there's no shame, nothing wrong with facing reality and saying at some point, the people who, typically parents will be passing along, and there will be assets that pass down to the next generation. You're not going to know the exact day, of course, that's going to happen, but whether it's 5 years or 10 years or 15 years down the road, you can build that into a financial plan. So at some point, you may have an infusion of cash that becomes available to help fund your retirements as well. Those are the most common sources of income. And as you're doing your planning, you just look and fill in one of the budgeting spreadsheets. You just look at each of those that are applicable to you, put those numbers in, and that will really help you form the base of the income that you can rely on in retirement. And now we're going to move on to section 4, which is filling the gap. So you've kind of determined, here's how much I want to spend, here's how much I have to spend, and you now just need to know, are you okay? Are you on track, or is there a big gap that you need to fill? If you're in the fortunate situation where you do your calculations, you do your math, and you have enough, and you expect that will last you through your retirement, that's awesome, good for you. From an investment perspective, don't forget you do have typically decades worth of retirement funding ahead of you. It's common that people kind of take a very, very cautious approach when they get into retirement. If you have enough to provide you with your income flow, but not a ton of extra, keep in mind the money probably will need to be remain invested to counter inflation, because as we talked about earlier, I think prices are going to continue to rise whether you're retired or not. So you're going to want to grow that money, and in fact, the sort of the rules of thumb that we looked at anticipated some growth. Let's look at some different time frames of how close you are to retirement and looking at some investment strategies there. Let's look first at if you are 20 years or more from retirement. You have a lot of time is on your side. You have quite an investment horizon in front of you before you get to that point where you're going to start drawing income. I'm never an advocate for being a speculative investor. Don't take huge bets, but you definitely can orient your portfolio to more growth oriented. You can buy, have the asset allocation shifted more towards growth, less in fixed income, bonds, cash, that type of thing. Make sure that you have the fortitude, if you're going to go that route, to ride the ups and the downs in the market, because they will come. The fact that you're younger, when the markets do crash from time to time, and if you're 20, you're going to go through some crashes, it does you no good if the markets drop, you pull your money out, you wait till they go back up, you put it back in, and you repeat that cycle. So time is on your side, take advantage of it, but most importantly, know what you're doing. Now, if you are somewhere from 10 to 20 years to retire, so you're in that stage, if you're on track, well, just keep doing what you're doing. You've obviously been doing things right so far, and I wouldn't make any major changes to that. It's not time yet to be cautious, and obviously don't be overly aggressive as well. If you haven't built up a nest egg yet, fortunately it's not too late. You can actually dedicate more of your resources to building up the portfolio, again, if you're in that sort of 10 years or 15 years out from retirement. I would say in this stage, you want to really start focusing on the savings, and as much as you can comfortably allocate without living like a hermit, take money, establish a regular investment program, and just keep building that nest egg up to just provide you with more comfort when you get to those retirement years. If you are 10 years or fewer from retirement, so now you actually see the finish line. You may have some very specific goals that you're able to identify now. If your math shows that you're on track, just keep doing what you're doing. Maintain a balanced portfolio. No time to take unnecessary risks, but it's also probably too early to put your money under a mattress as well if that day ever comes. So just keep that balanced portfolio and keep putting an allocation of your percentage of your income into a plan. and stay on track. Now, if you're behind and you have fewer than 10 years, it will be tough. I mean, it's just, you got to call it what it is. If you've just starting now, you've lost the benefit of compounding, which is one of the most powerful aspects of developing a nest egg. Urgency is of the priority. Really start putting aside as much as you can right now. I found through my working career that people around the age of 50 kind of finally got serious about investing. It might be late 40s, early 50s, but somewhere in that range, people started, I guess because you can sort of see the end in sight, and you look at your investment account and you go, wow, this is not where it should be. Take advantage of, in most cases, or in many cases, you're going to be in your peak earning years right now. So if you can, trim your expenses and start putting more and more money away to investments. At this point, it'll be more saving than it will be investing, just because of the fewer years that you have until retirement. But even when you get to retirement, don't forget, you'll be there for a long time as well. So just keep plugging away that in that respect. From a portfolio perspective, take a more moderate stance. The last thing you can do right now, and I see people doing this all the time when they do the math and go, wow, I'm way behind, I better ramp up the risk. You may get lucky and reach a target that you've set for yourself, or have more money in retirement. However, there's also this risk that you're going to take a big hit if the markets just turn against you at the wrong time, and you just can't afford now to take a huge drop that's just going to set you back too far, and it could be, I would say, catastrophic. If that's the case, if you are closer, you may have to just sort of face reality and go, I may have to work a little bit longer, whether it's a year or 2 or 3 years. Extend the time horizon of when you're planning on retiring. You want to make sure your money is managed safely, and do the best you can to increase the rate of return without taking an inordinate amount of risk. And maybe just start shifting your mind, or start with that mind shift of what retirement looks like if you can't afford the dream. So you've had all these visions in your mind, and maybe now maybe some regret, but if you simply don't see being able to achieve those, start preparing yourself now for what that's going to look like. So when the day comes, you don't want to be in retirement and be depressed or regret looking back over your life. So mentally prepare for that as well. I want to kind of recap what we've talked about today in this quest to answer the question, how much will I need to retire? First of all, you look at when you're going to retire. That time frame between now and then is a key factor. You want to estimate what you'll need. And this is something that only you can do. You can use those rules of thumb, which are a start. If you go and spend the time doing a proper budget, that'll give you a much clearer picture. Review the sources of income that you have. So do you have government pension plans? You probably will have government pension plans. Do you have private pension plans? How much have you built up to provide you with that? Step number 4 in this equation is assessing where you're at. So do you have a shortfall? Do you have a surplus? If you have a gap, take the steps to fill it if necessary. If it's possible, then do everything you can to just really start focusing on that retirement date. And in many cases, if you're behind, you'll be able to catch up. I hope this has provided you with some real structure and thoughts as to the things that you're going to need to know to retire comfortably. But I am curious, what did I miss? I know there's so many different scenarios, and clearly in a video like this, you can't address every individual scenario, but I'm hoping that there was nothing obvious that I left out of this. But if I did, for a future video, I'm welcome all comments. So if you want to drop a line and just say, well, what about this, or should we be considering that? I welcome that and look forward to being able to respond, whether it's by answering comments online, or whether it's at some point creating another video on this topic. As always, if you aren't sure about investing, but you've identified that maybe it's something you probably should be doing, and you want to really take that serious and learn the proper way of investing, the first link in the description below is for our Investing Academy. And I mean, that's what the whole Academy is structured for. It's helping people, whether you're a raw beginner or whether you have more experience, just fine-tuning your portfolios or starting from scratch if that's the situation you're in. And whatever guidance we can help in that regard, just check it out below. I'm going to wrap up this probably rather long video. And thank you so much. If you've stuck around till the end here, thanks a lot. I really appreciate that. If you did find the video valuable, maybe just take a moment, give it a thumbs up, drop a comment, and that will help spread the word. And maybe there's other people who are in circumstances similar to yourself who would benefit from watching the video. Thanks very much for watching, and I look forward to seeing you in the next video.